Hi, I'm Jonathan Bays, and this is our April investment market update. An improved market the last couple of weeks, recalling that 6 or 7 weeks ago we saw markets fall 10 or 11 or 12% over 3 or 4 days, perhaps concerning ourselves more about a slowdown in growth for the latter part of 2018 during the last 4 weeks, as we saw the rhetoric on trade protectionism pick up. A bit of a guide or some context for you in that regard. The opening gambit from the United States was to put 25% tariffs on about $50 billion worth of Chinese exports to the US. The Chinese retaliated in kind with a similar quantum on US exports to China, at which point then Mr. Trump suggested potentially a further $100 billion of products out of China receiving a tariff on them as they enter the United States. And the context on that is $150 billion of Chinese exports is a bit over 30% of the $430 billion that China exported into the United States. And if they in fact brought that to bear, it would really start to reflect a genuine trade war, and we would start to concern ourselves about economic growth looking into 2019. We've also seen increasing tensions, if you will, between the United States and Russia, and I think these will be a major contributor to increased volatility going forward. And these are one of several reasons why we've moved to a defensive bent in our portfolios. I certainly don't think that this whole spat between the US and Russia has peaked. And actually, just while I'm speaking now, a further issue that has the potential to upset the market apple cart in the coming couple of months is the ongoing investigation into Russian meddling in the US election and indeed the subpoenaing of Trump's personal lawyer last week.
Hi, my name is Kerry Craig, Global Market Strategist at JP Morgan Asset Management. The first quarter of this year may not have played out like many investors wanted it to. We saw increased volatilities, big sell-off in equities and in bond markets, and returns haven't been that favourable so far for this first part of this year, despite a global economy that actually looks like it's in pretty good shape. There's a couple of questions that got raised which really are preying on the mind of investors so far this year. One is about interest rates and just how far they will go, what that means for equity markets and what that means for the outlook for central banks. We do see a world where we have higher rates of growth coming through. Although some of the data was softer in the first quarter, we think that will return to a rather above trend growth outlook for the rest of the world. Central banks such as the US Federal Reserve are going to continue to hiking interest rates over the next couple of years. The ECB will end its quantitative easing program this year and stop buying bonds and eventually raise rates next year. And even here in Australia, we think about the dislocation between the Australian economy and the rest of the world. We're hearing an increasing amount of rhetoric from the RBA that they will move higher in interest rates rather than lower when they do eventually move. So higher interest rates around the world, that does mean the question about should I own bonds or equities at this point in time becomes more important, especially in that context of volatility and thinking about how to be defensive in portfolios. Because of that, we do think it's important to have the appropriate amount of diversification within portfolio, having those hedges that allow to mitigate for that volatility, and also thinking about your time horizon. As many market watchers like myself and others, we tend to get caught up in the day-to-day or in the week-to-week of how a market's behaving. Think about having a long-term investment horizon, and long-term money needs a long-term home. Don't get too caught up in the day-to-day volatility in markets that we may see come through this year. Like any good boxer, being able to take a punch is just as important as being able to throw one.
A few words on Australian equity portfolios. As a bit of an update, we made some changes in recent months that I think it's worth flagging up. A lot of these have involved smaller and mid-cap shares and move away from some of the larger, supposedly blue chip shares. In recent months, we've advocated for selling out of Wesfarmers and Woolworths, both very good companies. Woolworths has had a tremendous re-rate in the last 18 months as the business has restructured, in fact, and started to win back market share. But again, on 18 or 19 times earnings and with very little growth, we think it's been worthwhile selling out of it. And equally, Wesfarmers having troubles in the UK on their recent DIY purchase. So in advocating for selling out there, we've looked to put some money into some of the smaller and mid-cap stocks with better growth prospects and on better valuations. APN Outdoor and Downer Group have recently been advocated for, and in recent days, in fact, the Afterpay story is another one. Small caps in Australia are about 14 or 15% of the total share market by weight. We've been overweight small caps for some time and currently have about a 20 or 25% overweight in portfolios in small caps. APN has bounced beautifully. The start of the year on outdoor advertising has been great. The stock was on a particularly low valuation and has really outperformed the market by about 20% in the last 6 weeks, which is good. We've seen overnight the Australian Prime Minister announcing approval and funding, if you will, for the Melbourne Airport train link. We think Downer will be a really material beneficiary from that. The stock's on 13 times earnings with a great dividend yield, and it's actually come back since we advocated buying it. So I think that'll bounce really well. And Afterpay, which has been volatile in recent weeks and been in the press a lot, we think is a tremendous opportunity to buy a great long-term growth story, and so be pushing that into portfolios in the high fives, low sixes. That's it from me. Have a great month, and we'll talk to you next month.